The global banking system is a mystery. There are about 30,000 different banks around the globe, and they hold enormous sums of assets. The top 10 banks alone are responsible for about $25 trillion in US dollars. Banking may appear difficult today, but the initial goal was to make life easier. Italy was the center of European trade in the 11th century. Merchants from around the continent gathered to trade their wares, but there was one issue. There were too many currencies in circulation. Merchants in Pisa had to cope with 7 distinct types of coins and regularly had to swap their money. This exchange business, which often took place on public benches, is where the name bank comes from the Italian word banco, which means bench. People were concerned about the perils of traveling, counterfeit money, and the difficulty of obtaining a loan. It was time for a new business model. House brokers began to extend credit to business owners, while Genovese merchants pioneered cashless payments. Bank networks strewn across Europe, extending credit even to the church and European kingdoms. How about today? Banks, in a word, are in the risk management industry. This is a simple explanation of how it works. People keep their money in banks and earn a tiny interest. The bank then lends this money out at substantially higher interest rates. It's a calculated risk because some of the lenders will go bankrupt. This activity is critical to our economic system because it offers resources for people to buy items like houses or for businesses to expand and grow. So banks take funds that savers do not utilize and convert them into funds that society may use to perform things. Accepting savings deposits, the credit card industry, buying and selling currencies, the custodian business, and cash management services are all sources of income for banks. The main issue with banks today is that many have abandoned their historic position as providers of long-term financial goods in favor of short-term rewards, which imply higher risks. During the financial boom, most major banks adopted barely understandable financial constructions and did their own trading as a habit to make quick money and pay millions in bonuses to their executives and traders. This was little more than gambling, and it harmed entire economies and communities. For example, in 2008, banks like Lehman Brothers extended loans to virtually everyone who wanted to buy a house, putting the bank in a highly risky risk position. This caused the housing market in the United States and portions of Europe to collapse, forcing stock values to plunge, finally leading to a global banking crisis and one of the worst financial catastrophes in history. Hundreds of billions of dollars have simply vanished. Millions of people lost their jobs and significant amounts of money. Most of the world's top banks were fined billions of dollars, and bankers were among the least trusted professionals. The US government and the European Union had to come up with massive bailout packages to buy risky assets and keep banks from going bankrupt. New laws were enacted to oversee the banking industry, and mandatory bank emergency funds were mandated to absorb shocks in the event of another financial catastrophe. Other pieces of stern new legislation, on the other hand, were effectively prevented by the banking lobby. Other finance strategies are rapidly gaining traction today, like new investment banks that charge a yearly fee and do not receive sales commissions, providing the motive to operate in the best interests of their clients, or credit unions. These are cooperative ventures founded in the 19th century to avoid credit sharks. Summarized, they offer the same financial services as banks, but they prioritize shared value over profit maximization. The self-proclaimed mission is to assist members in creating opportunities such as starting small enterprises, developing farms, or building family homes while investing in communities. They are governed by their members, who democratically elect the board of directors. Credit union systems vary greatly over the world, ranging from a few hundred members to organizations with several billion US dollars and hundreds of thousands of members. The emphasis on rewards for members influences the risk credit unions are willing to accept, which explains why credit unions, while also struggling, fared far better than traditional banks during the recent financial crisis. Not to mention the recent boom of crowdfunding. Aside from making amazing video games possible, platforms evolved that let people obtain loans from big groups of small investors, bypassing the bank as a middleman. However, it also works for industry. Many new technological businesses began on Kickstarter or Indiegogo. The financing individual feels good about being a part of something bigger, and they may invest in ideas they believe in, while distributing the risk so thinly that the impact is limited if the project fails. Last but not least, there are microcredits. Lots of tiny loans mostly given out in developing nations to help individuals get out of poverty. People were previously unable to obtain the funds required to establish a business because they were judged unworthy of the time. Microcredit lending has now developed into a multi-billion-dollar industry. So while banking may not be your cup of tea, the responsibility of banks in delivering finances to individuals and businesses is critical to our society and must be fulfilled. It is up to us to select who will do it and how it will be done in the future. This is CryptoWalk. I'll see you in the next one.